panelists up here. Alex, you want to kick us off? Quick 2 seconds, who you are, what you do.
I'm Alex Buriak. I'm the Senior Vice President over at Jet Lending. A little spiel about Jet Lending, or just me?
Go for it.
Jet Lending, we are an asset-based lender. We've been around since 2004. Short-term, long-term, commercial, land, new construction, anything investment real estate, nothing owner-occupied. We actually help you evaluate everything that you're trying to do, so make sure it's in line with your business plan and profit margins before we close. You close in about 3 days from clear to close from title. Hop on our website for all of our educational videos and everything that we can do to help you. And I hope you guys enjoy everything tonight.
Kathryn Orfino. I am with Mr. Texas Real Estate. Wear a lot of hats, primarily investor relations. Do a lot of work with the Mastermind folks, helping them understand the buying and lending process and work through that. And then for our own portfolios, I'm usually the buyer's agent on our commercial transactions.
All right. I'm Zach Wilson. I'm with Quest Trust Company. We are the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country. Best way to think about us is we are simply the private asset version of companies like TD Ameritrade, Charles Schwab, Fidelity. Right? They allow you to take your retirement funds, put them into the public market. We allow you to take those same retirement funds, put them into privately held assets. Specifically, real estate style investments is what we specialize in. Currently, we have about $2.7 billion in assets under administration, with about $400 million cash uninvested with our clients' accounts.
Hi guys, I'm Rebecca. I'm on the Mr. Texas Real Estate team as well. Not only do I help out with the lending, but I also help out with the events here at the investment center. I represent the residential sector with Paramount Residential Mortgage Group as the lender.
All right. So a couple of you guys went to a big private lender event last week in Vegas, which I'm sure was really boring. Like there was nothing to do but just go to seminars all day. So what was Alex, we'll start with you. What was the big takeaway?
Some of the big takeaways were, now when you go to a national event, they're going to go through national statistics. So one of the big takeaways you're looking at is you're going to see a fluctuation in change in capital markets. Okay, so your price of funds, your cost of capital, how do you use that change in cost of capital while buying different types of assets? And I know I'm being very general because there's a big, broad conference with a lot of different type of lenders and institutions. So one of the biggest takeaways was you should still be buying while the money is out there. We'll get into that today because everybody's waiting for this crash like Jason was talking about. And when you can buy things for 30, 40 cents on a dollar, money is an issue. So still get out there and utilize that capital while it's available. But asset classes are still very strong. Single-family homes are still very strong. Commercial assets are doing very well. So everything was still producing very well, but it's just a time as in the investment market to pivot, is what I took away from it.
All right. Kathryn?
Yeah. Similarly, I took away, we're not anticipating any kind of crash in the real estate market. What the types of loans you can get as an investor have changed, and the types of loans that make sense have changed, but you can still get loans. And in fact, the strange thing right now is, as an investor, you can get a loan for about 1% more than you can as a borrower on your own house. And that tells you that there is a lot of money out there looking for a home when that spread is only about 1%. And yes, underwriting conditions are changing and the rates are changing from day to day, but you can still get loans to buy real estate even with all the craziness. And if they thought the market was going to crash, that would not be possible.
All right. Zach, you guys just had your big Quest event. I'm sure rates and everything else were topic du jour, but what was kind of the big takeaway? What was the fervor there with all the attendees and the folks speaking?
So I mean, I'm kind of going to echo them. It's really that the market crash that everyone's been talking about simply just isn't arriving, right? We don't have the same conditions. While things are, they're rocky right now, it's not the time to hold your money put in a safe, right? if you have the ability to purchase an asset, do it. All right, put your money where you want to. The only difference is now where you're looking to borrow those funds.
Okay. And Rebecca, you work with mostly homeowners going in to buy like a house, to live in, that sort of thing. So what is their mindset right now as they're going in and staring down 6-7% interest rates?
Well,
Is this the proverbial date the rate, marry the house? Is that what everyone's using these days?
yes. I mean, unfortunately, a lot of people have just stopped, put it on a pause and a hold. I had a lot of people that were waiting just for house prices to come down, and now they're just waiting for interest rates. So it's put a lot of people off, especially this time. We used to encourage our homeowners, and we used to remind them that, hey, you can get your tax exemption, and you don't have to pay taxes next year if you buy this year. But since that has changed and you can actually do your home's that exemption the same year you buy, we don't have that. We don't have those people that are looking to purchase at the end of the year. So we're not seeing that. And also, my company is progressive in giving us tools and in these times. So they were really progressive into giving us a tool. It's just a loan product that is a seller paid buy down. So for the first year, you get 2% interest rate reduction. The next year, 1%. So they're going in at a 5 and a 5 1/4 or 5 and 5/8 and instead of the 7s and the 6s. So that's helping with a lot of the realtors, educating them that if you know anybody that's on the cusp, tell them we do have a resolution. And they're also, my company's really good about educating us, partnering with Barry Habib about what's going on and how to forecast and talk to your clients. They say interest rates are going to go down, right? But it's not going to happen tomorrow. They're really waiting. We're waiting on this recession because, like you say, what happens in a recession? Rates go down. Today's, purchases or tomorrow's refinances, but they're projecting probably Q1. We should hopefully see this. So that's our projections that we're getting.
Okay. So I'm a brand new investor, or I'm just an investor that's scared. I watch the news constantly. You shouldn't. But I watch the news constantly, and I'm just scared. There's going to be a recession, and I read all these people on Facebook, and there's going to be a 50% reduction in houses. And so I'm just brand new. I don't know what to do. What's the best bit of advice that you can give the new investor? And we'll start, Alex, with you.
The best advice I can give to a new investor is, one, understand break it down to a foundation. What are you trying to accomplish as an investor first? Okay, because you have to figure out, you're buying these asset classes, you're buying these single-family homes or multifamilies, warehouses, whatnot, okay? First, what are you trying to do, okay? Second, get your money in line, okay? From there, your fear is based on the unknown. Okay, so you're coming to places like this to educate yourself, to figure out what are you supposed to do. But just like anything else, as markets change, there'll be new unknowns that you fear. So you have to figure out, is your fear really just based on you're not trying to make a move yet, and because you don't really know what you're going for. So my advice to you in this market is to still buy, but you have to understand all your variables. What is your cost of capital? Who is your lender? Are you using somebody like from Quest? Are you using somebody like me? Are you using a national lender? So you can equate all your profit margins. You have to understand all the variables which it takes to buy. So your holding cost of your lender, your association dues, your utility bills, everything that encumbrances you buying this property, and understanding that first and continue to keep going. The second thing, if you are going to be a flipper in this market, you have to buy them deeper because your holding costs just went up. So you have to reevaluate where you stand in your projections. Any changing market that you're in, you have to be prepared to pivot. Those who pivot are going to make a mint in each market. Those who stop, you stop business, you don't make money. So you have to be able to pivot with this market to figure out where your profit margins lie.
All right, Kathryn, you work with the Mastermind. We get some people in there real scared.
Yeah.
What's going to happen to my $50,000 in this property? What do I do?
The only way you're guaranteed to lose is if you don't act. I think we were talking earlier today, Jason, you said that houses under 300,000 had gone up how much year to date?
20%.
Had gone up 20% year to date. So that means that your money that you saved to buy a house that you were nervous about moving forward on because there was some volatility on the market and we were coming out of COVID or whatever your reason was, where you could have bought a $100,000 house. Now you can only buy an $80,000 house. Go on HAR and see how many of those there are. It's the same thing now. The crash isn't coming. If you're going to get into real estate, yes, understand what you're trying to achieve, but understand that if you don't buy, you are losing. And that can be, I think, helpful in overcoming the fear of the unknown, because there will always be unknowns. But if you don't act, that's what guarantees you the loss. If you buy, it always takes a little while to get through that first flip, to stabilize that first rental. It's a learning process. But until you actually do it, you'll never complete that learning process. Do your due diligence and then do it.
Yeah, honestly, that's the best way to put it. I'd say if you're just getting started, really narrowing down your game plan, right? So a lot of people when they first discover, real estate is where they want to go to. That's kind of it for the idea, right? I know I want to invest in real estate. What does that mean, right? That kind of means nothing. It's like saying, oh, I want to make money. Well, obviously, right? But you got to come up with a game plan. I think what's important to know is, what does your cash flow need to look like? Do you need immediate cash flow now? Are you looking for something that can return? You want to buy a buy and hold? Do you want to get some renters in there immediately? Or do you want something that can take some time, right? Do I want to purchase a property that I know is going to require some repairs? I know I'm going to have to put some money deep in, and the payoff is going to be down the road, right? So coming up with a game plan, I think, is going to be the first step, but also finding that balance of, analysis paralysis. There's a lot of routes you can go, right? But find one that fits your needs and pull the trigger on it, right? Once you do that, don't get distracted. Find your niche, do your research, do your due diligence. There's tons of resources out there for every avenue you'd want to go, but you have to make that decision on which avenue it is. All right, once you do that, like I said, pull the trigger. There's money out there to be found. You just have to know where to look.
Me, basically, I work with a lot of first-time home buyers. So my topic to them is, where's your rent going? Like, do you get that back one day? You're essentially throwing it away. So even though you might have a higher mortgage payment, I tell them, coach them, this is like a savings account. And I use my example of how I bought my house 5 years ago and I have $100,000 in equity that I can do whatever I want with it, right? Pull it out, cash out. I let them know it is a savings plan that you do get back one day. There's no better return on it, which I've learned here. The stock market and things of that nature are not going to have the same return. So if you really want to get the bang for your buck, it's in real estate. And I'm just kind of coach them a little bit differently, is don't worry about maybe putting your 20% down, maybe put a little less, invest it in the house, because we're going to refinance as soon as rates go down. And then you get rid of your mortgage insurance and your house is worth more and you're in a better situation then. So it's just getting started. And then they, as long as they're coached correctly, they'll be in a much better position down the road shortly.
So I've never had anybody ask me this question, but it's one I always have in the back of my mind. And that is, when should I not invest? And it's one I kind of mull over and over and over. And I'm like, when should you not invest? Like, there's got to be, when should I sell my portfolio and get to cash? Because one of the things I find fascinating is all these folks will get on Facebook and they'll say, world's ending, real estate's going to crash. And I'm like, so did you sell your whole portfolio? No. Well, wait a second. If you're just going to buy it back for 50 cents on the dollar, why wouldn't you just sell it? And one of the things Logan is famous for is he says, look, if you don't believe in your model, everything looks like a crash. And he's 100% right. So is there a time, and Alex, will start with you, is there a time in which we shouldn't be buying real estate and maybe kind of step back and wait, or start to liquidate a portion of our portfolio?
No, I don't. There is never any market that I feel that you should not buy real estate, because it's all about pivoting strategies. You have to, and one thing I want to make clear to you guys, you have a lender up here, you have multiple lenders and people deal with money. if we really thought that the market was going to collect, we're just going to give you lip service so you can use our money, we make money, right? Well, if the market crashes, I have to end up with all these properties that aren't selling. Why would I want to deploy? Right now, we've deployed $117 million this year of our own capital. Why would I want to do that if I know I was going to take everything back at a loss? I'm trying to stress to you that this is not a sales pitch. I have no interest in lending you guys money that I have to take back at a loss. Okay? So I'm trying to tell you, in my opinion, there is never a time you don't buy. It's how you buy. So if you are in, let's say, look at the people, before I did this, I was a doctor, I was a physician, and I got into real estate to open another practice. I never left. So when the 2008 crash hit, I started this in 2011. So I was on the upswing. I saw more millionaires made on the down market going to the up market than I have ever seen in my life. And that's why I knew I started loving this business. I've never seen it. So any market is a valuable market as long as you buy within the parameters of that market. So I don't ever say that you stop buying in real estate. You tailor your business plan in which the market in which you're in. That's my answer.
I agree with that 100%. I'll get a little more specific. If you want to be super active and monitoring daily and pivoting, which is as things happen, which is what we do daily here at Mr. Texas Real Estate, and we change strategies, and we did all during COVID, and we're doing it today, you can do that. Do you have, 30, 40, 60, 80 hours a week to put into real estate? If you don't, and you want to invest in real estate, single families, if you just wait, go up. Other asset classes within real estate do better at sometimes versus others, but a standby staple is your 1 to 4 unit that anybody can buy with a conventional mortgage, and all of those eventually go up. So it really depends how hard you want to go, how much time you want to put into it, how prepared you are to do the research, do the pivots when it comes. And if you want to be active and own your own properties, but you don't want to work that hard at it, the 1 to 4 asset class over time always goes up. Just buy it right.
Yeah, that's exactly right. And I'm going to echo what they said, but I don't think there's never a time where you shouldn't be looking to purchase. It's just about what you're looking to purchase, right? Like they're saying, even if you're having trouble getting hold of single family homes, or let's say you have a single family home and you're having trouble getting it off, the long term, right, it's always going to increase. The longer you hold, the more value you're going to have across the board. It doesn't matter the condition of the market or what little spikes and dips that we see. The long-term goal is always going to be going up. If you feel right now that you don't have the ability to get into the single-family space, right, that doesn't mean there's not avenues to go with people who are able to get into it, right? When you can't directly buy, look at funds. There are funds. If you want maybe just a consistent return, look at existing notes, right? You have people like Jet Lending. You can purchase the notes and you got a consistent return. They do the vetting. There are avenues to go. I just don't think there's ever a time not to get in. You just got to find which door is the right one to open.
I was just going to comment that, some of the single families that you're seeing coming up a little bit more, because I get, my clients call and like, hey, I want to put an offer on this house, run the numbers. And, there are still some good opportunities, a little bit maybe more distressed houses, or, like, can this qualify for additional financing? I send it to my department. They're like, yes, this is still within conventional guidelines. So you're seeing a little bit more of that come back. So I feel like there's a little bit more deals out here now than there was, say, a couple months ago. So.
It's interesting you bring that up. The common analogy is if you guys played sports, and basketball, football, it doesn't really matter. Pick your sport. But if someone just hesitates for just a second and they take a half step, instead of a full step. And then you're able to get a little breakaway in there. I mean, you get a pass off, you get a shot off, whatever it is. And that's what I feel like the marketplace is like right now, because it's moving so fast that we've got, and not to use this as a pejorative, but the non-professional investment class, which is pretty big, right? Guys that do this every day like us, I mean, there's not really a whole lot of us, but the non-professional investment class is like, ooh, rates have kind of gone up. I bought 6 houses this year. Maybe I should buy this one. I'm not sure. And by then, we've already zipped around and we got that deal. We should have never gotten that deal because they were real close to it. And that's something we've certainly noticed. I'm going to go to the audience here in a minute, but I got 2 more questions for you guys. Where do you think, it's a 2-parter, where do you think interest rates will be end of this year and at the end of next year? We'll start with our first-time home buyer.
Yeah. So we just
folk.
had a rate hike. The feds came out and announced. So, they said, oh, look, the job reports are still good, even though it was service industry, which is not really that good for us. So so they raised again. So I think that we might see one more interest raise by the end of the year. But like I said, we just had a capital markets call, and my company is projecting, hopefully by Q1, we'll see a dip. What dip? I don't know.
Right?
Any dip would be a good dip, though, from where I'm at. So
You're going to get blown up by every mortgage loan officer that just made the cut. You guys are watching any of the mortgage news right now. One of the reasons you're seeing a lot of craziness in the market is because they are slashing staff like you wouldn't believe.
Yeah.
It's absolutely wild. So you're going to get like 900 emails saying, oh my God, it's down a quarter point. Ah!
yeah, my pipeline is just full of people that are just sitting and waiting. And I, encourage them too if the numbers aren't, ideal. I don't want to push them forward now. I'm like, hey, as soon as rates drop, let's, so my whole pipeline is just full of people that are just waiting, to hit that perfect number, or get close to it, or just be down before they were, to refinance, cash out, all that kind of stuff, or to move forward with some properties that have been looking for a particular property but are kind of holding off now. So it's going to be intense when it happens. So I'm going to rest up.
Yeah. All right, Zach, you got to hit this one on the button. I'm calling Quincy.
No, don't get Quincy involved. But I believe that we're going to end this year still pretty high. I don't think we're going to get turned around super quickly. I think by end of 2023, we'll see a dip. I don't know if we're ever going to see it go back to, the 2s. That may have been something that was a once in a generation dip. But I think hovering around 4 to 5 is a reasonable thing. Come maybe end in 2022, going in 2024. Or 2023 going into 2024.
Kathryn,
Yeah.
you deal with all kinds of crazy investors, and so what?
Yeah,
what do you
rates. I expect rates to go up further this year, no question, in my mind. They may or may not go down next year. If I had to guess, I'd say they might go up. Certainly in the first half of next year, some more. That's my take. And it's really based more on supply and demand than anything else. I don't have a PhD in economics. There's a lot of smart people out there talking about it. By the end of next year, I really don't have any idea what will happen. But I do agree that the 2s and 3s are probably not coming again anytime soon. And that at some point, yes, we'll get back to 5 or 4. I just can't say whether that'll be by the end of next year or later than that.
Yeah.
My gut tells me later than that. I hope I'm wrong.
Yeah, it's like I feel like in this industry, it's still a shot in the dark. I just have a little match right here.
Yeah, nobody knows how to predict it. It's too volatile. I mean, they don't, and nobody's seen anything like this. So nobody wants to make a direction on which way to go. So it's really hard to predict and plan.
And it's affected by international news, international events, COVID shutdowns in China, war in the Ukraine, things that we have absolutely no control over end up affecting interest rates. And who knows what's going to happen?
All right, Alex?
Okay.
I'm not hearing a lot of positive news over here from the 3 panelists, but maybe you can, maybe they're going to be 2% by the end of the year.
So first, expect a rate increase probably in December. in February. As they're going, they'll talk of softening that, but I'm prepared as a lender, them going up 75 bips again, just being preparing myself for it, because that increases my cost of capital, changes how I can loan to you. This is my own personal opinion, because like Kathryn said, it's based on all these variables. It depends on what happens in the midterms next week.
Oh, election. Yeah.
It happens, and no matter who wins, the other side is going to blame the other side for everything. Know that now, okay? So I personally don't see a substantial dip. I think you're going to see fluctuations of things going up and down because you're going to say it's stabilizing. So I think in 2023, you're going to see a lot of that. I personally don't believe you are going to see a substantial decrease in rates till Q3 of 26. And that's if the 24 election goes in a certain direction and that person gets inaugurated in January 25, and then they have to redo policy the rest of 25 if the House and Senate go along with it, and that brings into 26. That's why there's all these variables. So if those things go correctly in our favor for capital markets, my opinion is Q3 of 26. But there's a lot of things wrong that can go wrong, and a lot of things at play that you guys have already seen that you've never seen before in these markets. So that is an opinion. I hope I'm very wrong.
No, they said that too. There are going to be brief drops and dips, and so if you're shopping and you're good, you might be able to snag a good rate, but it won't be consistent as we were the first of this year.
I hope you guys tell me that I'm wrong and it's not Q3 of 26. But that's my own personal opinion.
You're out there, and I can tell you that real estate investing is a very lonely business. We may do gurus, and we may do education, and we may do online websites and all that stuff, be in the message boards and feel like there's a connection there. And it can be very, very lonely. And so what we have done is created this mastermind. Now we don't have a big education program. We're not selling books and tapes and DVDs and all that other stuff. What we have set up is a group where like-minded individuals can participate and become wealthy. Now, does it happen overnight? No. That's why we have a 1, 2, 3, 4, 5-year program. And as you guys come into this mastermind, you're going to find folks that are just like you. So we lay all this stuff out to really sort of make those transactions to grow your wealth as smooth as possible.
The few ranch guys I talk to, and actually all our business partners here in the building and a couple other partners we have, they've all bought ranches. And I'm talking a couple 100 acres at a time. And they tell me, Jason, if you want one, you need to get it now. That's all they tell me, every single partner meeting. You got to get it now. And I'm like, I know. I just got other stuff going on. So I don't see that mark. And then farmland has been on, I swear, like a 20-year bull market. Farmland's been absolutely insane. It's one of the reasons why these family farms keep losing their land. The value is just shot through the roof. So but we don't do that kind of investing. So probably not the best advice from us. Speaking of home values, what do you guys think by the end of the year, what are we going to be up? 10%, 20%, 100%? Where do you think we'll end the year?
Year to date?
Yeah, year to date, calendar year. January, where do you think we'll end up by the end of the year?
Well, my opinion, especially on the HAR statistics, one thing I got to look at is how this. You ever hear the term, you can make up 70% of the statistics, 80% of people know that? So one of the things that I'm looking at the statistics in the HAR report is that right now the median home value is $411,000, and the average. The median was $376,000 in September. So why is that? Is it just because things cost more? Well, also there's nothing to sell below $300,000. So all your average prices are reflecting these higher value sales. So I think that you're going to end up creeping that back up. And I don't see a sharp increase, but it may return back to 420 because in about June it was about 426. So I think you're going to end up in the averages, still in the low fours, and I think your medians are going to end up anywhere from 350 to 380.
Okay. When last year it was like 300.
Right.
It's cost of waiting, and it was 50 G's. It's kind of wild when you think about it.
$50,000. Yeah.
Kathryn?
I'll talk in terms of percentages. So I think at the end of August, we were up 18% in the Houston area. We're now heading into the normal seasonal decline, which lasts through the end of the year. So I'm going to say 18%.
Yeah, I'm not even gonna pretend to know as much as these guys up here when it comes to the exact metrics. But overall, I know, kind of going back to what we talked about earlier, people say, "Oh, I'm just gonna wait, right? I'm gonna wait for that big drop. I'm gonna wait for when it crashes." I think the conditions of the market means that what flooded the market with supply in 2008 is not going to happen again, right? You're not going to get this massive flood of these foreclosures, just going wild. And so I think, honestly, we're going to see, a little bit of a dip, but if that, especially in the Houston market, so I don't think we're going to see anything crazy.
What I'm seeing is a slight dip to when everything was at its highest this summer. So just general research, the house in my neighborhood at its very highest, the highest sold house that went, of course, me being a neighbor, super excited. I'm like, I can get that for my house. They had the couple that bought it, overpaid, right? Highest bid. I've lost out on every house. So we're going in big, won it. For whatever reason, they've had to put it back on the market this last month, and they're listing it for what they bought it, and it's sitting there. It's going on 30 days.
When did they close on it?
June,
So what do you think? This is actually a good exercise. So what were interest rates in June?
They were definitely a point lower,
Yeah, I think
a point and a half.
I think prime was at 4.25 in June, so I think they're probably 5.5.
5.5, 5.5.
And now we're in the sevens.
Yeah, it would be interesting to see if they have to take a discount. Of course, the other problem is, where do you live? I always forget.
Over by Northwest Vintage Park.
Okay.
By Kathryn and
We call that,
Robert.
okay. You live in breeder country.
I'm a burb.
Yeah.
Yeah, we have, I think, typically our little neighborhood is about a 7% seasonal drop. Once the kids are back in school, prices drop 7%. And then as we get towards the end of the school year, they jump back up.
Yeah, they jump back up. So it'll be interesting when breeder country, it shuts down. There are certain neighborhoods, it's specifically in Cypress and Tomball, where it's like day one school starts, don't even bother to listen to house. Just don't even bother, because it goes completely dormant, right? But it'll be interesting, that 5.5% versus that 7% interest, what you could do the math, see how much the principal would have to be reduced by where those things would be equal, right? Mm-hmm. But in any case, so we're seeing, I am trying to snag a $1 million lake house on the daily, and I'm seeing that market soften. In fact, we were going to do a flip down in Sienna Plantation. My girlfriend's sending me all these houses, really nice houses. You ought to move down here. I'm like, I'm not moving down there. Anyway. So then she sends me a text, you'll love this, it's a big piece of shit. And I was like, okay. And she was absolutely right. It was a HUD foreclosure. It's in the old section of Sienna, if you guys are familiar with that. It's right across from the amphitheater on the lake. And I contracted it at 536 or 563, something, I don't know, 540, 550. This past summer, that house would have sold for $1.2 million all day long. Needed $200 to $300K in work. Didn't have a pool. Needed a pool to hit that higher end number. So we went on the cruise, and I was still in my option period, and I watched one house that was pending. It was 1,500 square feet larger. It was listed at about $1 million, and it went under contract pretty damn quick. Beautiful house, on the lake, the whole backyard oasis. You walked into the house, it has those staircases that go all the way around. It's about 7,000 square feet. Just a beautiful house. So I'm watching this thing. We get back we got back on Tuesday, Wednesday? We got back on a Wednesday. So it had closed the night before. So I pull it up on the phone, It closed for $850 grand. 6 months ago, that thing would have sold for like 1.4. So I immediately executed the option, pulled the contract, said, I don't know what this thing is worth, and I'm out. So we're seeing some volatility in that higher end marketplace. We're making a lot of offers right now. I really want a lake house on Conroe with like an actual like wide open lake view, not just on the lake, but I want the full lake view. And that stuff at $1 million plus is softening pretty quickly.
I think the appraisers have identified a couple markets that they're actually declining markets, like Arizona. And I think there was another one that you guys, did they talk about at your conference? Another market that they said was, not quite sure. So, I mean, we're not here, thank goodness. I sent a couple final inspections out and crossed my fingers, and they're not choosing the declining option period. So we're good for now.
So there's a couple of markets called COVID markets. And those COVID markets saw these massive run up in prices because people could work from home. There's a couple in Tennessee. There's some in Washington, Oregon. I'm trying to remember the other submarkets, but other states. Oklahoma. There's some places where they had these rapid appreciation. You're like, and I'm getting the monthly reports, right? And I'm like, 46% year over year in Chattanooga. I'm like, what the hell is going on? Like, anyway, and what it was, oh, we can work from home. And so everyone was like flocking to some of these markets, and it just jacked up prices. Now all of a sudden, this is like, are you guys familiar with the term COVID stocks, the stay-at-home stocks? Zoom has gotten obliterated, right? Because no one really has to use, you're still using Zoom. It's still funny, whenever I get on Zoom, I'm still screwing stuff up. I'm like, we've been doing this like 6 years now, still can't get it right. But anyway, so those stay-at-home stocks have gotten battered, right? Well, there's stay-at-home marketplaces that have gotten battered. So that's what's popping up on a lot of those reports. So I started drilling down the data. I'm like, why are these markets getting obliterated? And then you start to find some of the local realtor reports, and they're saying, yeah, these were COVID neighborhoods, these were COVID submarkets where everybody moved out because they thought nobody was going back to an office and everybody's going to work from home, which that kind of didn't turn out to be the case. So we're definitely seeing that in those marketplaces. What other questions do you guys have?
Well, one thing I want to add about marketplaces, for you guys that are buying properties, hopefully, I'm going to change it. You guys are buying properties. Let's do that. And for you guys, please do not take any comps prior to August.
100% agree with that.
Okay? Do not comp something and say, well, in February, no. If you get an appraisal back from your lender and there is comps from February and they did not adjust that comp, you are being swindled, my friend, because that market has died. Okay? So just remember, pay attention to the real estate network that you're in. Pay attention to the market in which you reside. Comp in the market that you're in as well. Don't try to find comps to make your deal work, because that life doesn't exist anymore. So I'd say from about August, okay, and then up. Just as a heads up.
And with something we've been seeing recently coming in on appraisals is an economic instability phrase, where basically if you get something at a deep discount compared to the comps, your appraisal is going to come back at your purchase price. And the reason, and then they'll put, due to economic instability, I'm nervous about putting this at the level that the comps actually show. And I'm far more likely as an appraiser to get sued for giving too high an estimate than I am for too low an estimate. I'm matching your purchase price, so you should still be able to qualify for your loan. And we're seeing some of these appraisals come back silly low. We have tried to challenge some of them. No luck.
It's very difficult to challenge.
It's very difficult to challenge an appraisal. So that's something to be aware of, that these things, some of them are great and we never want to push values, but do a good CMA, get a good CMA, get good comps, and be aware that your appraised value is sometimes coming in below what the real value should be. Now, if you're in it for the long term, that's kind of good, because it'll keep your taxes down. You just need to be aware, hey, if I did need to go sell this, I could probably, here's some examples of some things that are actually closer to what the true value probably is.
All right, guys, what else you got? They're tied, by the way. Not that I'm looking up here when they're talking, I'm just saying. That's kind of what we've been talking about, refinances, and I mean, it's all going to be sort of the same. You're going to be at what rates are you guys going to be at? Yeah, you have to bring more cash to closing and cover the shortfall. Although what we've seen is, I'm seeing more loans below 1.0 DSCR.
Yeah,
which is
so
like,
we won't do them below 0.75 anymore. We took all those products off the market. They're too risky.
I'll tell you guys, your even your days of 1.0 may be numbered.
Yeah, it's hard.
you don't make any money below 1.
Especially because
so
the
it's like-
taxes just came out. So I had one deal in, like, barely made it with the new taxes.
So prepare for a 1.2. And if you guys are buying condos, don't forget your association dues. Your association dues will probably almost kill every one of your condo deals.
Yeah.
And if you live in if for any reason you're buying like this $800,000-$900,000 house, that you're like, well, I'm going to short-term rent it, but it's not a destination rental. Look at your association dues, your homeowners association dues on that, because that can kill your deal too. So look at your fees that you have to pay on your dues on the property, because that equates into your mortgage, and it's going to severely shift. It's like, oh no, it's cool. It's like $200 a month, and it's going to kill your deal. So if you're dealing with a lender that's giving you long-term loans, make sure you give them all the information. Never let somebody on the other side of the phone make you feel that they're superior to you. You have to pretend like they have the same type of knowledge you do. Like, oh no, they're professionals, they got it. Make sure, say, are you aware of this? Are you aware of that? They're just normal people, just like you. So just make sure you're very concise and choose your words very carefully on how you talk to people, and say, here's my HOA dues. There's another maintenance fee that goes on. This is what I'm trying to do. This is how much it's rented for. Everything in line. And you will get an answer much quicker, so you don't waste time.
I think when it comes to DSCR stuff, what you're going to see is not necessarily in rental properties. You're going to see it in multifamily. I am real close friends with David. David was here last month. And one of the things we talk about confidentially is there's going to be a lot of Class A apartments that blow up and Class Bs, because taxes are going to go through the roof. And it's going to, it may trigger those lockbox provisions that most banks have. So we're going to see some apartment deals, some syndications just get nuked. Probably Q2, Q3 next year. They're going to be negative cash flowing because taxes are going to go way up. And insurance is way up. You guys, for those of you who are landlords, insurance getting any cheaper these days? No. So why is that? It has nothing to do with a hurricane. Cost of construction's gone through the roof. So here you are, a multifamily landlord that bought a Class C plus at a 5.5 cap, tried to put in low-flow toilets to make an extra $50 a month, and then you get slapped with taxes and insurance. They're going to get killed. We're going to see some deals hit the market that, my guess is we're probably going to get phone calls from the bank that's taking them back. That's going to be my guess. That's absolutely going to happen next year.
And pay attention to your floodplains, especially in Harris County. You guys doing and look at your deed restrictions on when you have to make foundational changes to the home, because you have to be at least 1 or 2 feet above the 100-year floodplain. And your floodplain insurance is astronomical. So I'm not saying don't buy in the floodplain, but buy it in accordance of your costs. So if you know that you're buying in Meyerland, why? But if you're buying in Meyerland, make sure you attune for your insurance in which you need for that property. It's like, oh no, I'm buying it at 60 cents on the dollar. No, you're not, because you didn't plan for your $7,000 flood insurance. So you have to. That's why we look at all your variables, and if you don't know what they are yet, build a team. You have a bunch of new friends today. So everybody get to know each other. Talk to Jason, talk to me, talk to Kath, talk to everybody, and we'll help you out and get the money that you need and making sure your variables are in line.
We can all get to know each other at Papacitos. That's what we can do. All right, thanks a lot, guys. If you would, round of applause for our panel. All right, I'm going to Papacitos to watch the rest of the game. You guys are welcome to join. But is that anything else you need, Darrell?